So, of course, not everybody thinks that regulation is a good idea, and in the US particularly, there've been some of this regulation has been rolled back. A lot of that was under Trump, and there were three kind of main arguments against the degree of regulation that had been introduced. One was that actually, regulation. The danger with regulation is it can lead to a decrease in competition, and the reason for that is that it makes it harder for small banks. That's because regulation, complying with regulation involves a lot of form filling, checking, and so on and so forth. It's effectively a regressive impact because smaller banks, they have less revenue, but the cost of regulation is probably still quite high. In other words, as you get bigger, you still got to do the same sort of regulatory stuff. But in terms of the likely cost on you, it's a smaller proportion of your revenue. So that damages the ability of small banks to compete with big ones. So that could lead to negative outcomes for consumers. Secondly, there's an argument, obviously, that regulation leads to an increase in costs. Therefore, that's going to lead to a decrease in the profitability of banks, and therefore that could decrease innovation in the banking system. It could decrease the spread of new technology and so on and so forth. So we've all benefited from contactless payments and so on. So if banks are less profitable, maybe there'll be fewer innovations in the future. How much banks' profits are really being damaged by this is open to question. And thirdly, excuse me. And thirdly, an argument has been that actually it's there's an argument made by Donald Trump, but that actually it kind of favours the wealthy, or rather, it doesn't favour. It kind of excludes low-income groups. So it's harder for you to get a loan if you don't already have lots of money. And that's always been one of the problems with the banking system. But when we were talking about some of the regulation that insists that you have a certain proportion of the value of a house before you can get a loan and so on, you could see that it works against low-income groups. And the argument from the market is as long as these people are taking informed decisions, if the bank wants to lend them money, then it should be able to do so. So those are some of the arguments against regulation. And Trump was quite keen to try, and the Trump administration was quite keen to try to roll back this regulation because they saw it as unnecessarily restrictive. That it was limiting the ability of people to get loans, to start businesses, and so on and so forth. And therefore, there were kind of three main changes that have been made in the last few years, mostly in 2020. Firstly, there was a relaxation of something that's known as the Volcker Rule. It's very complex, but loosely, the Volcker Rule stops banks from using customers' ordinary deposits to engage in investment banking activities. In other words, it's supposed to keep your ordinary savings safe. That was one of the things that went wrong during the financial crisis, is that banks took big risks with customers' money, and then had to be bailed out. They've relaxed that a bit, so it's easier now for banks to use customers' money, to engage in investment banking activities. Secondly, to try to reduce the regulation on small banks, small local banks, they don't have to make detailed. They don't have to make detailed credit checks anymore on people they're lending to. So there's less need for detailed credit checks. The argument being that these small local banks probably know the people that they're lending to anyway, and if something bad does happen to them, then it doesn't have a major impact on the economy as a whole. But again, we're increasing risk again. And thirdly, there's been these annual stress tests that we talked about before. Fewer banks now have to do them. It's only now for banks that have assets above $250 billion that have to have these stress tests every year. That's reduced the number of banks, therefore, that are tested from 38 to 12 in the US at the time of speaking. Yes, it's 2023. Again, you could argue that it's only the biggest banks that we really need to worry about, because they're the only ones that can take, have that major impact on the financial system. But again, we're reversing this kind of anti-risk attitude, and we're making the banking system more risky, perhaps, than it was, kind of 5 or 10 years ago. And some people are saying that this is exactly what led to the financial crisis in the first place. Was the deregulation of the banking system allowed banks to take big risks and lend money, which led to the bubble, which then led to the crisis back then. Whether or not that's going to be true, I guess we'll have to wait and see.